So we now need to switch to what we call Plan B. The problem with tax reform is it's so incredibly complex, and the government, I don't think, has any idea of the ramifications of what has come across, what they've created, if you want to look at it from that perspective. So we have to take a look at possible solutions to what we would do in our structures in order to mitigate the impact of these things. Because if you want to think of it in a real simple bottom line, it's this. If you end up paying 72% tax on passive income in a corporation, then you will need to do everything possible to simply not have any taxable income in a Canadian-controlled private corporation. And the question is, all right, well then how would we actually get that done? So let's take a look at some things that could work. This is a portfolio, a balanced portfolio, and it shows where the kinds of returns are coming from. What I've tried to do is break it down this way. Things like deferred gains that you earn often on real estate, a return of capital, which is also from real estate, or also deferred gains can also come from holding equity positions for a long period of time, or private equity, are basically not taxed at all on a current basis. Interest, rent, and foreign income is taxed at 100%, dividends at 2/3, capital gains at 50%. So when I have a portfolio earning an 8% return, typically in a year, in a balanced portfolio, it might be 3.5% is taxable. So let's convert that into some numbers. We have a $3 million portfolio. Return in a given year was $240,000. The taxable amount, which is what we're looking at right now, is $105,000. Right now, in the company, the tax rate is almost 50%, but there's a refundable tax amount, which is 2/3 of that, that is triggered, that would bring down the net corporate tax to 19%. But it only gets triggered if I take the money out and pay personal tax on it. I would have to take a dividend of $85,000, and depending on what my business tax rate was, I will pay tax somewhere between $35,000 and $26,000 on that dividend. Net bottom line is, my blended rate, personal and corporate, under current taxation, could be as high as 52% or as low as 45%. It's in that, almost 50% range, even at the lower level. So that's the current taxation. Now, if I change this to the current taxation and cut out the capital dividend account and RDTOH, which are ways of equalizing investment income in corporations to investment income personally, then the dividend will be taxed at 41% personally, and my tax rate is 72%. That's how I get to the 72%. So I have to figure out a way to basically not have the $105,000 of taxable income in that company. I could take a look at taking that income and paying out a bonus or a salary, because regardless of what my tax rate is on a bonus or a salary, it's not going to be 72%. I could make my charitable gifts that I'm going to make now, which have been typically made personally, and I could do them corporately. I could offset this with interest expense. For instance, I could put the business loans I have in my operating company into a separate holding company and expense it at that level. And I could design my portfolio so I had a smaller percentage of my portfolio earning high taxable income, like straight interest income, for example. Reasonableness will be needed as we look at all of these things, but these are all ways to mitigate the problem. So we're going to look at them in a couple of ways. Let's just start with this one. So some of you that work with us already have individual pension plans. They've been around since the early 90s. What I'm going to do is I'm going to use the future Cheryl, she's now 60, and say, how would it look for her? So what can happen is she can take the value of a pension. If she'd actually had an IPP since 1991, there would be about $800,000 in it today. The government says, yes, well, we have to take into account you've been saving money in an RSP, so we're going to reduce what you can put in by that much. But you can still put in $310,000 in 1 year, which is a very significant amount of money. And you can put in $40,000 for each year that you decide to continue to work. But if you decide to retire, we're going to let you put in a super amount. We're going to let you put in a large lump sum that will almost bring this pension up to what you would have got if you'd come and worked for us. It's close, okay? So that would allow you to put in $1,550,000. So let's just look at this graphically. It looks like this. I can put in total funding of $1.55 million into a pension plan. Now, of course, Cheryl doesn't have $1.55 million of taxable income. So the question is, how could she use this? Well, the first thing she can do, which she wasn't able to do with her RSPs at age 60, is she can take any income she receives from this pension and split it with her spouse. She can also, if she's not going to take the income now, she can defer future earnings to age 71 and compound the income tax-free, keeping in mind in her corporation the tax rate is 50%. The contributions for putting money in are tax deductible. She can offset the high rate tax on passive income. So how could she do that? Well, she's allowed to amortize the funding over 10 years. So let's just magically assume that she was earning $100,000 of taxable income on her portfolio in her company. And we have this large unfunded liability in a pension. We could fund that for 10 years at $100,000 a year, and we would have no taxable income in the company, and a bunch of money would now be moved into an IPP. She could trigger pregnant gains, which would maybe have been taxed at very high rates if she tried to take them out personally, and then offset them with the expense deduction of the IPP. They're generally better for most people roughly after the age of 50, which means this is not something 30-year-olds or 40-year-olds are going to do. And there are some issues to consider. First off, there are limitations to the investments you can make. They're the same as the ones that apply to RSPs. So things like being able to buy real estate directly would not work for an IPP. They're fully taxable in the estate on whatever capital has not been spent by the beneficiaries of the pension. So an insured version is an option to mitigate that particular problem. And they have restricted liquidity. You can't just cash out an IPP. It has to be received in a form of income over a lifetime. So it's not the perfect solution. It may be part of one of the solutions. Now, another thing that people have been promoting recently, especially since this tax reform came out, is leveraged insurance. And there are ways to use it, and there are ways I would suggest to not use it. So if you think of insurance as an asset class, you have to look, is it that or is it an expense? Can it be used to create income during your retirement? How does it compare to other fixed assets on risk and return? And how do you maximize the benefits of insurance that you're buying for needs? So, in real simple terms, insurance is simply a plan where you put premiums in, a large part of the premiums go towards accumulating tax-deferred savings, and the rest of it goes to the cost of insurance. So, pretty straightforward stuff. The reason it can work is that when companies issue par insurance, they're actually investing all of the par portfolio, like in this case, this is Sun Life's, for example, in a portfolio of real estate and really good stocks and private debt and mortgages. They're in a balanced portfolio. They're in a very good portfolio earning a good return. But because they're in an insurance par portfolio, the insurance company has de-risked it for the investors. So the cash values embedded in the insurance policy are guaranteed, even though the underlying assets may fluctuate in value. Essentially, you end up with bond-like risk, but you get balanced fund returns. And in addition, of course, the money's compounding tax-free. So the way it can be used is you take your low-risk assets, you can put them at a certain rate, not unlimited, into a tax-deferred insurance policy like a par policy. You can then turn the par policy over to a bank and borrow money and put it back into the portfolio, but this time into assets that might be income producing, such as real estate or dividend paying stocks. So overall, if you're going to use leverage, and in most cases, I would say a lot of our clients do not need to do this in terms of they don't need the leverage, but a line of credit is better than a term loan. There's no need to increase the risk of their portfolio when you do this, and you try to buy assets that generate cash flow, like rental income or dividends from, or income from calls or puts. So in terms of mixing active and passive income, many of you have been building money in your corporations that were also your active business, and they're basically mixed together. This is going to be a potential problem if tax reform passes as written. So we have a company that makes $1 million a year, but it also has a $3 million portfolio with $100,000 of taxable income. The way it typically works now is that the parents are either active in the business or the primary shareholders. It's not unusual to see that some of the shares are owned by a family trust. Salaries are used to maximize RSPs. Maybe a dividend is paid to the lower income earning spouse. Dividends are paid to the kids to fund university costs, which is exactly one of the changes they want to eliminate. No dividends allowed between 18 and 24, and that helps to recover RDTOH. So think of that as the current, maybe past model. So as we switch to what might be the future model, in this case, we have an operating company all by itself. It just runs a business. It may still be owned by a family trust, and one of the beneficiaries of that family trust would be a holding company, allowing dividends to go to a holding company, we've isolated the high tax income into one single entity. That entity then can distribute income, maybe in the form of salaries, pension benefits. We won't be able to pay any dividends to these kids, probably based on the new rules, at any age. It really won't make any difference if they're 30. But one thing that might work extremely well is if this couple has tax-paid capital as a result of how they've invested over the years, they could make a direct loan to that trust of that capital, and the income on that capital could then be allocated to the children. That kind of income splitting still works. I'm going to comment on that a bit later on the issue of timeliness. So we have investment in business loans in the holding company. We distribute taxable income by bonus and maybe fund part of the IPP, and the rest of the salary and benefits come from the operating company. The point of this exercise is, if that portfolio is generating $75,000 of taxable income, we need to get that number to 0. If the rules are written as proposed or come out that way, that would be the result we have to get.